Jenna Barnard, Fund Manager of Henderson Diversified Income Limited. Now let's start with the asset allocation. We've seen the allocation to secured loans come down recently. Why is this?
Well, it's really been the case that the loan weighting has fallen significantly over the last 12 months, and that is purely because loans are no longer offering a relatively attractive income. So today about a quarter of the company's assets are in loans. These are floating rate assets, so their income is linked to interest rates. Obviously, base rates, interest rates in Europe have gone negative, and they're at very low levels in the UK and the US. So we found over the last 12 months there have been much better income opportunities in fixed rate bonds where the coupons don't change, and where, frankly, yields have been higher than in the loan market.
Where are we with gearing at the moment? Some investors might see this as a proxy for risk.
Well, the gearing is running at about 20% as of the end of March. And when you look at the fact sheet, you need to add both the physical gearing, in terms of bank debt, to the synthetic gearing, which is the use of credit derivatives to enhance income. So if you add those two together, both numbers are on the fact sheet, it would come to around 20%. Our limit is 30%, and we're gearing, you may well see the increases actually in April. So the gearing is generally a measure of confidence, but it's also a function of future loan settlements. So, you know, gearing may look artificially low on the fact sheet because we expect some loans to settle in the coming weeks. And frankly, redemptions and opportunities that we see in the market at any one time. So my message would be not to read too much into the gearing. You know, maybe at 20% at the end of March and back at 25% at the end of April. It's going to fluctuate, you know. So, so at the moment, it's not a signal of confidence or concern.
Now, there was a piece released recently about how in the high yield market, more investors, retail included, are taking more risk. Are you taking this approach?
We're trying not to. It's quite a challenging market, I would say, in credit markets at the moment, particularly if you're an income investor. So there is a temptation, I suppose, to what we call grab for yield or increase risk in order to maintain the income or the dividend, and that's something where, as experienced investors, we're trying to avoid. So we're turning down a lot of the new deals that are being shown to us by the investment banks. And we're still seeking out decent opportunities in the secondary market where risk levels or credit stories haven't changed. So names that we know and have liked for a long time, rather than investing in new, perhaps more aggressive deals which are coming to market over the last few months.
Okay, finally, let's talk about one of your successful themes in legacy Tier 1 banking bonds. How does this contribute? Is it income or is it capital growth?
Well, over the last 12-18 months, both. So this was a very attractive income opportunity. I think it's still very attractive. These bonds are generally yielding between 4.5% and 5.5% still. But 12-18 months ago, they were yielding more like 7 or 8%. So we've clipped the coupon, but we've also made capital as the price on these bonds has risen. We expect there's still some opportunity to make capital, because essentially these are bonds or capital from the banks which are being phased out under new regulation. By 2022, they won't count as Tier 1 capital. So we believe that the banks will try and buy these bonds back. And the key about the bonds we've been buying is they mature after 2022. So we've made capital, and we still think there's some more capital to be made as the banks look to either tender or exchange these bonds.
Jenna Barnard, thank you.
Thank you.